So thank you everyone for joining today. This is the part of FIN 20016, Ethics and International Finance lecture, and this is a part of Academic Voice session, and which is basically the part of the guest lecture series for some of the overseas offerings. My name is Dr. Sharad Khandekar. I am the unit convener of this unit, which is Ethics and International Finance, and today I'm going to talk about ethics and financial issues, and we'll talk about two different case studies. So, it's not really a lecture, but we'll discuss the case studies, what really happened. So it would be interesting for everyone, I believe. So first of all, I would like to do the acknowledgement of country. We respectfully acknowledge the Wurundjeri people of Kulin Nation, who are the traditional owners of the land on which Swinburne Australian campuses are located in Melbourne's East and Outer East, and pay our respect to the elders, past, present, and emerging. We are honored to recognize our connection to Wurundjeri country, history, culture, and spirituality through these locations, and strive to ensure that we operate in a manner that respects and honors the elders and ancestors of these lands. We also respectfully acknowledge Swinburne Aboriginal and Torres Strait Islander staff, students, alumni, partners, and visitors. We also acknowledge and respect the traditional owners of the land across Australia, their elders, ancestors, cultures, and heritage, and recognize the continuing sovereignties of all Aboriginal and Torres Strait Islander nations. Great. Now let's start. So why ethics? Why ethics is important in finance? Because we have seen that the ethical issues and finance actually goes quite hand to hand together. We have seen so many financial crises across the globe due to the ethical issues. We can start from the global financial crisis till look to the European financial crisis, and even if you think about the Asian financial crisis in 1997, all of these things happened due to the ethical issues. And the ethics and the financial crisis, we find that they're interrelated sometimes, and most of the cases we find that the ethical issues actually failed by the financial institution, and they actually put the profit over the responsibility, and those actually played a crucial factor or the contributing factor for those financial crises. And another of the reason is the poor risk management and risk avoiding factors. If you look at the several cases, say for example, you can see the cases in Australia, you can see the cases in Europe. Particularly, I will particularly talk about Australia today. The reason behind it in the Swinburne University is located in Victoria, Australia, and there are so many cases in Australia. We can clearly find that the ethical issues was actually not properly addressed, and profit put forward before any ethical responsibilities and the risk avoidance strategies. For example, we think about the Royal Commission, which actually established about a few years back about the banking sectors in Australia. We find that there are so many cases about the banks and the big banks like Commonwealth Bank of Australia, like NAB, National Australia Bank, Westpac, NZ. All these banks, they failed to their duty in order to keep the ethical duties upheld. So why why this is important? First of all, we find that there's so many cases the conflict of interest was raised, and and those things are not actually addressed properly. Second, we also find that during the subprime mortgage crisis, that there are some product was created. These products are so complex in nature, even for a finance professional, it is really difficult to understand those products. A good example for this could be different types of derivative products. So those types of derivative products, sometimes it's a bit difficult to understand and complex in nature. And whenever there are some complexity, there are always an opportunity to make some profit out of it. And we have seen during the global financial crisis what can happen. People know that there are some crises coming. No one did nothing. Third is the failures in regulation and oversight. The Banking Royal Commission report in Australia, it could be a good example for that. We have ASIC, we have APRA. APRA is Australian Prudential and Regulatory Authority. ASIC is Australian Security and Investment Commission, and we also have the Federal Treasury. But everyone, we have 4-pillar policy. Everyone failed to oversight these banking institutions. And another point is, the key ethical issues is the misleading rating by the rating agencies. It's like a bit of, if you think about the university ranking, I quite often talk about the university ranking. If you look at the top universities in Australia, for example, you'll find that University of Melbourne, University of Sydney, and probably the ANU is one of the top universities in Australia. But if you look at the different rankings, for example, we have a ranking from QS World University ranking. We have Times of Higher Education ranking. We have Shanghai Jiaotong University ranking, which is based in China. All three are great ranking, the great ranking body. But if you look at the Swinburne, for example, in the ranking, in one ranking, Swinburne ranked top 2 to 250, another ranking top 300, and so on. Even the Melbourne University in one ranking top 20, another ranking in top 30, you never know. So quite often, that the rating policies and the rating agencies' criteria are misleading. And guys, stop me anytime if you have any question, please. Now, in this picture, what I can put in here, that there are so many financial crises we have seen last 20 years. So many financial crises. So, for example, the first picture, which is actually showing in here, the subprime mortgage crisis during that time. What happened to the Wall Street? People are stressed. On the top picture, the guy is sitting, put his hand on his head. That he's thinking and he's stressed about what is happening to the Wall Street and the stock exchanges. The next one is the Royal Commission in Australia. So in Australian Royal Commission, they look at all the banks and they found it out that there are so many banks, they didn't provide any services to their clients, but they charge fees for their services. And it was, it was heavily criticized that why these financial institutions are big, they're massive. This financial institution, they charge heavy fees as a part of their commission or the part of their service they provided to the client, but they never intend to provide services. And if you think about the banks in Australia, for example, so if you think about 4 big banks we have in Australia, again, number 1 is Commonwealth Bank, followed by NAB, ANZ, and Westpac, the 4 big banks. If you look into the world ranking, all of these 4 big banks in Australia, they're ranked in top 100 in the world, in top 100 in any sense you make. If you think about, in terms of total asset, they're the top 100. You think about in terms of their market capitalization, they're the top 100. So they're very big banks. They're hugely profitable banks. And again, they failed extremely when they should provide service to the client. And the next the graph is showing about the annual growth of GDP per capita from 1995 till 2000. And if you look at in here, about in 1998, GDP per capita for most of the countries, actually, if you look at here, that all went down due to the financial crisis. Now, let's come back again then. So what is ethics? Now, this slide has been taken from your lecture slide. I think this was the first lecture slide on this unit, ethics and finance. As you know, that ethics and finance unit, it has two different modules. Module 1 is actually on the CFA ethics standards, and module 2 is from the international finance. So, that's why we did actually, talk about in here why ethics is important. All right, let's come back to the CFA, CFA ethics standard. Now, what is ethics? So ethics is the ethical value or the moral duties or the norms, what we learn from our family, what we learn from our religion, because the ethics and the religion goes hand to hand together. So if you think about the religion, regardless if you're thinking about the Islam, if you're thinking about the Christianity, if you think about the Judaism, all they talk about the ethical values. The values are the same. And most of the ethical values are codified in law. But not all laws are ethical. There are some laws which are a bit unethical, but ethics always have a higher moral ground compared to the legal aspect. As I said that most of the ethical issues are codified in law, depending upon which law we're talking about, because again, in the world there are different legal systems. We have the common law-based legal system, which is which is under the British Empire. Then we have the civil law system, and we have the post-communist legal system. Now again, in the civil law legal system, there are two different types of codification. One is the German-based civil law, another is basically French-based civil law. And there are lots of research in this area, that the law and finance, which law give the highest protection of the investor's right. And it is found previously that the common law countries, they give the highest protection to the investors' laws. However, again, not all ethical things are legal, and not all legal issues are ethical. Interestingly, there are some good examples. There are lots of good examples about actually what are the legal issues and what are the ethical issues. For example, a good example, quite often I give it to everyone in my class, about ethical and legal factors. For example, if you think about the USA, if you think of the US gun law, because of the Second Amendment, we can have gun. They need very less documentation, and some states in the USA, they don't really need, they don't really need that much of identification. But again, if you think about the ethical issues, how ethical this is. So ethics and law, there are some gray areas. Okay. Now, so as I said, that this topic is based on two different case studies. The one case study, the first case study is about case study 1, which is a strong financial fraud case. I'm not sure how many of you know about the Strong Financial. Now, the Strong Financial is a company. It was established in Queensland. So, if I try to be more specific, it was based on Townsville, Queensland, which is a financial advisory company. Now, the company was founded by two directors. The one director's name is Emmanuel Casamatis, and his wife, Julia. So they created this company initially, and which is called the Casamatis Security Private Limited in 1994. Now, this company, then they changed the name, and they changed the name in name to Ausdaq Security, if I'm not making a mistake. They changed the name to Ausdaq Security, and in 2000. And after that, they changed the name in in February 2004 as the Storm Financial Private Limited. Now, so they changed the name a couple of times, you can understand. Now, what was they doing? So they have quite a big business, the Storm Financial. They have, on the peak, they have about 146 employees in 13 different locations in New South Wales, Queensland, and Victoria. Now, their main product includes the investment unit trust, superannuation advisory services, life insurance, and also the different types of other traditional investment vehicles for the investors. Now, the Storm Financial, on the peak, they have about 13,000 clients across Australia, 13,000, and their asset size was, in the fund, about $4.5 billion. So you think about 4.5 billion, which is quite a big amount of money. And approximately, about 25% of their clients somehow, associated with their portfolio investment strategy. Now, one of the interesting thing I would say, or one of the main product, or the promotion the Storm was doing is basically, an investment strategy called the Storm model, which is basically they were giving the advisory services to all the clients, which is basically one size fits for all. So one strategy, everyone is the same. And those strategies sometimes was very risky strategies, and they actually advise to their clients. Now, the clients who are advised to borrow heavily using their home loans and the marginal loans. So most of their clients used to be the senior Australian people, senior Australian citizens. So those citizens were advised that they should invest heavily on. They should invest heavily based on borrowing capital from the different banks and using their home or also even the investment property loan. And then those funds, when those elderly people who are almost going for their retirement, they borrow money against their home, talking about hundreds of thousands of dollars, and they borrow this money using their home as a collateral. Those funds were invested on the indexed fund, which is a highly leveraged portfolio funds. So think about that one. They give this suggestion to almost everyone, to their client: borrow more money using their home and other assets, and they invested to those index funds. What really happened that during the GFC, when the stock market was going down, stock price was going down, thousands of the clients, they faced a serious decline on the share profit or the share price because the share market was going down. Some of their investment was also in the US market. So they invested in the ASX, they invested in the New York Stock Exchange. And when the New York Stock Exchange and the ASX was going down, I remember ASX, which is the Australian Stock Exchange, lost more than $1 trillion during the GFC. Though Australia is one of the luckiest countries in the world, they suffer almost, Australia didn't suffer actually to the housing market during the GFC compared to any other nation, but stock exchange was going down. And the US market, if you think about a big business such as the Citibank Limited, Washington Mutuals, those banks suffer significantly. Some of the banks, even they couldn't even sustain at all. They collapse. They need to write down billions of their assets. So when the stock market was going down, all these countries, and they have taken a huge amount of loan against their houses. This client, they were forced to sell their home to repay the debt. And it was a devastating impact on them for those retired people. They sell their house and they didn't have enough money. Some of them, they take money from their superannuation, and the estimated losses was more than about $3 billion. So you can think about the size of the losses during that time. Now, so the ASIC, which is Australian Security and Investment Commission, they start investigating about this crisis, what really happened. So ASIC, launched an inquiry into the Storm advisory practice and the client losses, and what they find that, Storm was giving the same types of advisory services to all of the clients, borrow money against your house, invest in a very leveraged asset, and giving suggestion to make money. So the initial investigation find that, they give the advice, which is an aggressive leverage model, which is not actually good fit for most of the elderly people. So they find it out. And then, ASIC also commenced proceeding against both of the directors for breaching the director's duty under Section 180 bracket 1 for the Corporation Act, that they failed to care about the client due diligence. Because whenever the client comes to the company for the investment purpose, they need to make sure those recommendations are appropriate for them. They need to make sure they did the due diligence, and they shouldn't be giving those types of advice to the vulnerable client, and those clients who are not very sophisticated in the market, and you're giving those advice which are not suitable for them at all. So, Storm Capital also going through the civil penalties proceeding as well during 2010. Now, there are so many couple of cases happened against them. So all of these clients were extremely unhappy what really happened to them, and the court found that the board directors breached their duties when they was giving advice through their 136 employees at locations about their investment. And then when they find the guilty on the federal court, they apply to this, I think, the Supreme Court, and again the federal court upheld the original ruling of 2.1 split decision confirming the breaches for the Storm Capitals. So at the end, they were guilty. The business shut down. The client, the Storm Capitals client invested about $4.8 billion investment, and through that investment index fund, and they lost about at the end they lost about $3.5 billion. And if we find that what really happened during that case, we find that mainly it happened because of the aggressive leverage model they followed, that they borrow extensively against their houses. They also give advice that the size should fit all, standardized investment approach for everyone. And also, we also can give blame to the GFC, because no one thought that GFC is coming in Australia. It was GFC in the USA because of the housing market collapse in the USA because of the very liberal borrowing policy followed by the US banks. So the GFC actually bring down the whole collapse. And also we can say that it happened because of the poor timing and risk management mechanism followed by the Storm Capital. Now, again, there are more than 13,000 clients that suffer in Australia. They lost about $3.5 billion through this process. Now, we can't only blame the Storm Capital. We can only blame the GFC. There is also something, the regulatory and governance failure as well. Australia, we got 4 pillar policy. We have APRA, which is Australian Prudential and Regulatory Authority. We have ASIC. We have RBA. We have Federal Treasury. These 4 institutions we have. All these 4 institutions, they should look at these factors. They should know what is happening. But they failed miserably, I would say. At the end, they punished. But again, think about the situation. This 13,000 client, they lost billions of dollars in early 2009. And eventually, the Storm Capital collapse. So that's all about the Storm Capital. The next one is basically about the case study 2, the Banking Royal Commission. Now, the Banking Royal Commission, they start investigating about what happened to the banking industry in Australia, and they created a Royal Commission from the Australian Parliament to investigate about the financial fraudulent duties or the financial fraudulent items, and also fee for no services, which actually happened due to several financial institutions in Australia. All the big financial institutions in Australia, you can blame them because of the unethical practice. So the Royal Commission actually established, I think, in 2018, established. Let me see. And they submitted the report, I think, in 2019 February to the Australian Parliament. The report included about 521 pages, and the report, it's a very big report. I read part of the report. It's a huge report. This report includes case studies after case studies, what really happened. Specifically, the financial planning industry was heavily criticized because of the breach of the trust of the customers and the client. Interestingly, the financial planning industry in Australia was a huge industry. Previously, the financial planners, by law, I'm a financial planner as well. I have RJ 146, which is a financial planning requirement. But in Australia, to get a financial planning, affiliation, let me put it that way, it was quite simple about 6-7 years back. After the Royal Commission report, the whole financial planning industry has been reorganized, reshuffled. Previously, to become a financial planner, you just need a VCA degree, and you need to have a certificate 4 or diploma in financial planning, which is basically very, it's not a very difficult course to do. You can complete in a couple of 6 to 8 months, and you can become a financial planner. Now, after that, this whole financial planning industry has been reorganized, and it was also, what can I say? The financial planning industries, the qualification changed. Now the student need to study a bachelor degree in order to fulfill the financial planning requirement. Now, in this huge report, 520-page report, which is submitted by the Royal Commission in Australia, they have 4 observations. Now, what is the Royal Commission? Quickly, I would like to mention in here. The Royal Commission is basically its highest parliamentary inquiry committee established by the Australian Parliament. Only few times it happened in Australia that the Royal Commission, by the name you can understand the Royal, what is there, has been set up to check the highest level, at the highest level to check is there any fraudulent duty, or is there anything unethical happened. So the Royal Commission report is submitted in submitted to Parliament 4th of February 2019, and there are 4 observations. So what I'm going to do, I'm going to read all these 4 observations for you, and then I'm going to explain what really happened. So the first observation, now I wrote down all in bullet point because the observations are a bit, it's a bit lengthy. So I'm going to read some of the observations and discuss some of them. The first observation is many cases of misconduct were driven by both companies' profit and personal gain. So the Royal Commission find whenever there is a misconduct happen, it happened through the company's profit and the personal gain. So the personal gain is basically the personal gain of the financial planners. Now remember, most of the financial planners in Australia, they were employed by the banks, and now when a client goes to the financial planner and they're giving commission or fees to the financial planner in order to get a good advice, what the financial planner did, instead of giving them the best advice, was giving the advice which is actually suggested by the banks. And they want to sell the product of the bank instead of giving the best advice to the client. So they're selling the product to the client. So they were selling product of banks, which is suggested by the bank for the client, who are thinking about the client's personal interest. So, and first observation, second point is helping customers became less important than making sales. So it was all about sales. Staff roles became blurred. Advisors are acted like sellers, and sellers acted like advisors. So it's all about everywhere. They acted like the sellers. They're selling product to the client. So the financial planner was selling product to the client, where those clients came to the financial planner to get advice. But the financial planner was selling product suggested by the bank. Misconduct is often linked to how people were rewarded for their action. Bonus and commission scheme focused on the sales and profit, not following the laws or doing the right practice. So bonus and commission is a part of the industry. Remember again, financial planning industry in Australia and mortgage brokerage, or the brokerage area in Australia, are basically it's commission-based business. Because this is a commission-based business, it is so the more they can sell, they can actually pay the commissions, and sometimes they don't get any fixed salary, but just a commission. So all these brokers or the financial planners, they just like to sell the product, because the more product they will sell, the more commission they will get. And people were rewarded even when the action were unethical or illegal. So think about it. For the bank, it was like, you sell the product, you make more, sell more and more product, you make more profit for us. We'll reward you regardless if it's an ethical or unethical issue. So the bank acts like that way. So this is the first observation by the Royal Commission. The second observation of the Royal Commission, all in bullet points, is the companies and individuals behave as they did simply because they were allowed to do. So the companies or the firms or the financial institutions, they act such a way because they know that nothing is going to happen. Because before, lots of congressmen in Australia, they asked for inquiry about the financial institution, but it was postponed, one after another. And specifically, the previous government, they were not really interested to set up a highest levels of Royal Commission. So, and that these big CEOs in Australian banks, they earn about, the compensation packages are like $30 million, $40 million. They really don't want a Royal Commission to be set up and investigate to the situation. Business controlled the terms of the transaction, leaving customers with little say. Most consumers didn't fully understand the product and services they were offered. Consumers had very limited power to negotiate or influence the terms. Their only option is to choose from what there was available, and often without enough information. So there was a clear imbalance of power and knowledge. And that there's an imbalance of power and knowledge. So the customers were not giving enough information, and the bank was sometimes forcing them. So for the customer, it was basically that they only have the limited option, whether you choose this available option or you just have to walk away. Most of the cases, the client didn't understand the terms and the conditions. They don't understand the product. Sometimes the products offered to them are not suitable for them. Complex product, very, very synthetic product offered to them, which are not fully understood by the client. And now remember that most of these investors are basically mom and dad investors, because this mom and dad investors, they are already reached to certain age, say for example 60 plus. They have some money to invest, so they want to have a balanced investment where they can get some money and return. And they don't really understand that much of investment vehicles. So this financial institution took the opportunity, exploit them, force them to take the product, what they are offering to them, and the client has very limited things to say. And the third observation by the Banking Royal Commission is the consumer often interact with the financial services through the intermediary. Clients typically assume the intermediaries act in their best interest. In reality, many intermediaries were paid and acted for the producers or service provided. Intermediaries might act solely on their own interest and the interest of client. Intermediaries and providers are not just different; they are often directly opposed. Now, interesting thing in here, if you look at the model the bank was practicing. Now, I don't know if there is, how many of you know about the Australian system. In Australia, we have about 56 banks. Out of 56 banks, there are about 5 big banks. I would say 5 big banks. So you know the 4 big banks name already, which includes NAB, ANZ, Commonwealth, and Westpac. The 5th largest bank is the Macquarie Bank Sydney, which is basically an investment bank, but they also have their now commercial banking operation. There are some other banks like the Bendigo Bank or also like Qantas Bank, but those are a bit small in size. So these 5 banks in Australia, they represent as much as 90% of the total bank's asset. Think about it. 90% of the total bank asset are represented by these 5 big banks. We have 56 banks. So remaining 51 banks, they have only 10% of the total asset. Now, out of this, the total asset, which is trillions of dollars. Now, again, each of these 4 big banks in Australia, their asset size is approximately $1 trillion. Think about each bank, their size is $1 trillion. Commonwealth Bank is more than $1 trillion. Now, quite often, and most of the cases actually, I would say about 90% of the, no, not 90%, 85% of the cases, whenever you go to a bank to borrow money for buying a house, you don't directly go to the bank, you go to a mortgage broker. And this is a common trend in Australia. About 80 to 85% of home loan are done or the deals are made through the mortgage broker. Now, the mortgage broker is a third party. So the bank is a financial institution. There is a client, and in between there is a mortgage broker. So the mortgage broker is not working for the mortgage broker is not actually a part of the bank. They are an independent person. So, but they have the accreditation of the bank. So the mortgage broker, they sell the product of the bank, and by this way they get some commission. That's the thing. Now, most of the client doesn't have any idea about that one. Most of the bank think, well, I'm going to the mortgage broker, and the mortgage broker, they're actually employee of the bank. So whatever they're saying to us is actually the word of the bank, but actually it's not the case, because the mortgage brokers are selling the product of the bank, and each mortgage broker, they might have affiliation with tens of banks. Okay. I am also actually, what can I say? So I'm also I'm having a financial consultancy business as well in Australia, and I do consultancy about this area as well. And I do have also some connection with the banks, but when we do deal with this, we're an individual party. But the bank is an individual party. The client is an individual party. But most of the cases, the mortgage broker, the way they acted, that the client was thinking that the mortgage brokers or the financial planners, they're the part of the bank, but they're not the part of the bank. They're selling the product. The mortgage brokers and the financial planners, they act as an intermediary, and whatever they say, which sometimes are not very correct for the client, but the client doesn't have enough things to do. Okay, and whenever those loans are given by the mortgage broker to the bank, sometimes the bank even won't check it. They just want to accept it. So there are so many cases happening in this area. And the fourth observation by the Banking Royal Commission suggested that the financial service entity that broke the law were often not properly held accountable. Deterrence of misconduct require entities to believe it will be detected, publicly denounced, and justly punished. Misconduct that generates profit is not effectively deterred by merely requiring compensation. So it's basically, the bank act in that way that they think that that they didn't really care about the law, because they know that only if they're caught, they will be punished. And if no one knows what is happening, they don't really care about it. Okay, so that's the fourth observation. So you can think about that, what will happen in the Banking Royal Commission in Australia. I will go to the next slide. Now, if you look at it in here, let me make it a bit bigger. Because the time is clicking, so I'll just try to make it a bit quicker. So the fine imposed by the Australian financial institutions on the Australian financial institutions by the Royal Commissions after the Royal Commission report, ANZ, so many misconduct by the ANZ Bank, they was fined $240 million. Australian Super, they were fined $27 million. Commonwealth Bank, $25 million and various penalty. I think in the Commonwealth Bank, one penalty was about $1 billion penalty. NAB, 10 million various penalties. So there's so many penalties for the NAB and AMP, small penalty. For most of the banks, such as Commonwealth Bank and NAB and ANZ, what they find that there are so many cases they didn't report the money laundering cases to the ASIC. So in Australia, the rule is if there's any transaction more than $10,000, whether it's deposited or withdrawn, then to inform to the ASIC. However, it was not informed. There are thousands of cases, if not million, that were not actually reported to ASIC at all. So there are so many fines imposed by the Banking Royal Commissions to all these banks. These are just a sample. And this slide is actually showing the last 20 years of the financial scandal of the world. So this slide can be seen, or you can find from your lecture slides. So we have subprime mortgage crisis, the Barney Madoff crisis about the Ponzi scheme. The latest one is Single Holding crisis in Australia for $25 billion. First Republic Bank in 2023, which is collapsed in Silicon Valley in the USA. Billions of dollars of the collapse. Wells Fargo collapse, 3.5 million fraudulent account, and so on. So what we can do? There are so many misconduct. The banking industry, wherever you go, there are misconduct in the banking industry. Even in Australia, we found out that the Royal Commission finds so many misconduct in the banking industry, and also, it's by law in Australia that these four big banks we are talking about all the time, they can't even merge together because that's too big to handle, and even the government do not want to mess with them. They're too big. Each of their assets is about $1 trillion, as I mentioned before. So government decided that these four big banks, they cannot merge with each other. So it's by law they cannot merge, but the other small bank can merge. And we have seen that small banks, they're merging. Some of the housing society in Australia, they're becoming bank to become more and more competitive. For example, the Suncorp Bank, the RAMS, the Qantas Bank, the Kudos Bank. So all this used to be basically the credit union or the building society. They became banks, and the banks become single most dominant institution in Australia. So how to deter the misconduct in the financial sector? Again, this slide is actually coming from your coming from your ethics slide, that what we can do. There should be a farm level practice. So it should be culture. There should be an auditing, regular auditing system, risk control and remuneration policy. So the remuneration is a big factor. For the industry level, there should be industry standard. For example, the ASIC has certain standard and the guideline, and then there should be some membership restrictions. And then for the government, there should be a codified standard. That's the government did in Australia after the Royal Commission, and civil and criminal penalties. So, for example, all 4 big banks, they receive some penalty. Not only that, one thing I would like to also mention in here, after the Royal Commission report in Australia also introduced a new law, and the law is called two-strike rules. Now, the two-strike rule is a system in Australia. This system, this two-strike rule system is to require the shareholders in a company to vote against the board remuneration policy with only 25% voting right. So any country in the world, so if you think about that, because the CEO remuneration became a very big issue nowadays, it's unethical remuneration policy. So the CEO remuneration could be, like, as I said, tens of millions of dollars. So in Australia, the shareholders, they do not need 50% vote to say no against the remuneration policy, because quite often you cannot get 50% vote to say no against the remuneration policy, right? So in Australia, the shareholders only need 25% vote to say no against the remuneration policy. So in the annual general meeting, if the shareholders are not happy with the board performance and the remuneration policy, they can strike. The first strike is 25% vote. When the first strike made, the board need to rectify the direction. If they don't change the direction, if they don't change the remuneration policy, in the next annual general meeting, if the shareholder vote against, that's called the second strike. For the second strike again, they do not need 50% vote, they only need 25% vote in Australia. So on the second strike, with the 25% vote, if they say no to the remuneration policy and the director's policy, the entire board will be removed and the CEO will lose the position. Okay, so in a couple of banks, actually, I think at least one, I think the NAB, they had the first strike, and after the first strike, they get very serious, because in the second strike, they will lose all of the position, all the big board directors. So that's all for today's guest lecture. Thank you very much for listening to me.